Jerome Powell curbs expectations for rate cuts. I'm Lisa Bernhard with Reuters, and I'm joined today by Kevin Nicholson of RiverFront Investment Group. Kevin, Fed Chair Jerome Powell, in a Q&A today in D.C., said that it's likely to take longer than expected to achieve the Fed's target goal of 2% annual inflation rate, and therefore to begin cutting interest rates. What was the market's reaction?
Well, the stock market had an interesting reaction. It came off of it kind of pulled back earlier today from its highs during the day. And the bond market really didn't respond, and largely because I think the bond market has gotten used to the higher for longer mantra.
I've had a lot of guests who sit where you're sitting who've told me that the Fed will not do anything when it gets closer to the election. So if rate cuts are going to be delayed, and in fact, they won't do anything closer to the election, does that mean that we won't see any rate cuts at all this year?
Well, it's our investment thesis that there wasn't going to be any rate cuts this year, but I would not say that it's political or that, just because you're getting close to the election that the Fed would not cut, because their November meeting actually comes 2 days after the election. So it wouldn't be seen as political at that point or having any influence on the election at that point.
So with the cost of doing business remaining high and borrowing costs remaining high for consumers, does this change your investment philosophy at all?
No, it doesn't, because my investment philosophy has been that we have a strong economy, that we have a strong labor market, and that as long as the U.S. worker is employed, they will consume. Our economy is based on consumption, and what we've seen over the last few quarters is that even with higher rates, the economy has been able to thrive, and GDP growth has been higher than it was pre-pandemic. So our investment thesis remains intact.
Tomorrow, the Fed's Beige Book comes out. Can you explain what that is, what you'll be looking for in it, and how important is it?
Sure. The Beige Book comes out 8 times a year. It's an opportunity for the Fed presidents to look at their district and see what activity is going on in their district. And so it's like they speak with bank officials. They will meet with other business leaders in the community, in their district, to find out the activity. So for tomorrow, a couple of things that I will be looking at, I will be looking to see how manufacturing is doing and how retail sales are doing. Manufacturing, because over the last year plus, we have been in contractionary territory, but basically having a manufacturing recession. And then it was last month when you saw the ISM manufacturing survey actually move across 50 and enter expansionary territory, and I want to see if there's continued follow through there. And we also want to see if retail sales are showing signs of cooling, or if they're going to continue to be red hot like the recent retail sales data that we got earlier this week.
Kevin, grabbing headlines today, former President Trump and Republican candidate, he is in court, but also shares of his Truth Social have really declined from when they went public, down some 60%. Now, that company went public via a SPAC. Can you explain exactly what a SPAC is and how those companies tend to do? Are they volatile like this usually after going public?
A SPAC is an investment vehicle that is designed to bring private companies public in a shorter period of time, where they actually are merged with a holding company, a listed holding company. Typically, in an initial public offering, takes about 3 to 6 months to get done to bring a company public, and in a SPAC format, it only takes about 1 to 2 months. And so you have a much smaller due diligence window in which to find out information on the company. And so once these SPACs go public, then there's more information out about the company, and it allows investors to do more due diligence. And I think that what ends up happening is that you get the hype initially, and then once they are then public, investors have more time to do the due diligence, and it typically deflates some of the air out of the balloon, so to speak.